This video is for educational and informational purposes only. It reflects personal opinions and does not constitute financial or investment advice. Trading Forex involves risk and may not be suitable for all investors. Always do your own research or consult a licensed financial advisor. Your trading decisions are your responsibility. Welcome back to Forex Mastery. In our first episode, we explored what Forex is and why it matters on a global scale. Today, we're getting closer to the core of how the market works by understanding currency pairs, the instruments we actually trade. In Forex, you never trade a currency by itself. You're always exchanging one currency for another. That's why trades are expressed as currency pairs. It's a relationship, a tug-of-war between two economies. You're buying one currency while simultaneously selling the other. Take EUR USD, for example. This is the euro versus the US dollar. If the quote is 1,000, it means 1 euro equals $1.10. If you believe the euro will rise in value compared to the dollar, you buy. If you think it will fall, you sell. You are not trading the euro or the dollar independently. You're speculating on the direction of their value relative to each other. The first currency in a pair is the base currency. The second is the quote currency. The number you see is how much of the quote currency you need to buy 1 unit of the base. If EUR USD moves from 1,100 to 1,1200, it means the euro has strengthened, or the dollar has weakened, or both. Now let's imagine a traveler exchanging euros for dollars at the airport. They hand over 1,000 euros and receive $100. A few days later, the rate changes to 1,1200. If they exchange back, they receive more euros than before. That small shift in exchange rate, that's what Forex traders seek to capture. Even small price movements, called pips, can mean real gains or losses, especially when trading with leverage. Every trade counts, and every quote reflects the current global balance between economies, governments, interest rates, and even political events. Now that we understand the structure of a pair, let's talk about how they're grouped. Forex pairs fall into 3 categories: majors, minors, and exotics. Major pairs always include the US dollar and another major economy's currency. These are the most traded pairs in the world. Examples include EUR, USD, GBP, USD, USD JPY, and USD CHF. Because of their high trading volume, these pairs tend to have tighter spreads, higher liquidity, and more consistent behavior. They're well documented, well researched, and widely traded. Ideal for beginners. Minors, also known as cross-currency pairs, do not include the US dollar. These pairs still involve strong economies, like EUR GBP, EUR JPY, and GBP JPY. They're slightly less liquid than majors and can have wider spreads, but they're great for diversifying your exposure beyond dollar-driven moves. Exotic pairs combine one major currency with one from a developing or smaller economy, such as USD TRY or EUR SGD. These pairs can be more volatile, less liquid, and more costly to trade due to wider spreads. They offer big movement potential, but with higher risk. Beginners should generally avoid exotics until they build more experience. Let's use an analogy. Major pairs are like well-paved highways, fast, direct, and efficient. Minor pairs are like city roads, a little more unpredictable, but still manageable. Exotic pairs are more like off-road trails, exciting but dangerous without the right equipment. So how do you decide which pairs to trade? First, consider your experience. If you're just starting, focus on 1 or 2 major pairs. EUR USD is the most liquid and widely analyzed pair, a great place to begin. Next, consider your time zone. If you're in Europe or the US and trade during the London or New York sessions, EUR USD and GBP USD will give you plenty of movement. If you're in Asia or prefer to trade during the Tokyo session, you might focus on USD JPY or AUD JPY. Also, think about your trading style. If you prefer slower, more stable price action, you might prefer pairs like EUR, UUSD, or USD CHF. If you like faster, more volatile moves, GBP JPY or GBP USD might suit your style. But remember, more volatility also means more risk. It's not just about movement. It's about your ability to manage that movement. Then there's personality. Are you someone who needs certainty? Stick to majors. Do you enjoy more adrenaline and can handle the emotional swings? You might explore minor or even exotic pairs later on. Let's go deeper with a case study. Imagine you've spent 2 weeks observing the AUD-USD pair. You notice it reacts strongly to Australian employment data released early in the trading day. One morning, job figures are better than expected. The Australian dollar starts climbing. You've seen this pattern before, you've planned for it, and now you take a long trade. Because you've studied the pair's behavior, you know where to place your stop loss and where to exit with profit. That's smart trading, not reacting blindly, but recognizing and responding to patterns. Another factor to consider is trading cost. Every trade involves a spread, the difference between the bid and ask price. In major pairs, this is typically very small. In exotics, the spread can be 10 times wider. That affects your profitability, especially if you trade frequently or use short-term strategies like scalping. And then there is slippage, when the trade is executed at a worse price than you intended, often during high volatility. This is more common with exotic or illiquid pairs, especially during news events. It's something every trader must manage, and it's another reason to start with pairs that offer smoother execution. Once you've selected a pair or two, don't jump around too fast. It's better to know one pair deeply than to trade many pairs poorly. Watch its behavior at different times of day. Notice how it reacts to economic events. Understand how far it typically moves in a day. Its average daily range. Some pairs trend more, others bounce back and forth. Learn its rhythm. Also, keep a trading journal. Record your trades, your thought process, and how the pair behaved. Over time, this helps you refine your intuition and spot opportunities faster. Your goal in this stage is not to master the entire Forex market. Your goal is to master one corner of it. That focus creates familiarity. Familiarity breeds confidence, and confidence, backed by preparation, creates consistency. So, to summarize, currency pairs are the core instruments we trade in Forex. They reflect the relative value between two currencies and are influenced by global economic, political, and technical factors. Majors are the best starting point for beginners. Minors and exotics offer more movement but come with higher risk. Choose pairs that match your schedule, your personality, and your strategy. Study them, specialize, and grow with them. In the next episode, we'll break down how a trade actually works. We'll cover spreads, pips, lots, leverage, and how to calculate profit and loss. You'll see the math behind the movement and how traders manage risk at the micro level. So keep watching, take notes, and keep progressing. From zero to hero. This is Forex Mastery.